Tariffs are a tax on imports. So look, any company that imports is going to see input costs go up and supply chain disruptions as well. I'm Andrew Korz, Director of Research, and today we're going to discuss the latest on U.S. tariff policy and the potential impacts on private markets. I'm here with my colleague in research, Alan Flannigan. Alan, thanks for joining.
Pleasure to be here.
We're also going to bring in Dan Wilk, our head of private equity solutions, for some of his thoughts as well, specifically on the private equity market. So today is April 9th. Country-specific tariffs have been in place since 12:01 Eastern Time, along with a 10% across-the-board tariff on almost all imports. Some from Mexico and Canada have been exempt. The tariff on China is now 104% as we speak. And as of this morning, China's now retaliated with 84% tariffs on U.S. goods. These policies, if they stay in place, will bring the weighted average tax on U.S. imports to more than, or somewhere around 30% from roughly 2% at the end of 2024. So look, this is clearly a huge event. Public markets have been roiled by the tariffs and the accompanying uncertainty. But, private markets don't trade regularly, but are increasingly a critical part of U.S. capital markets. And I think it's important we discuss some of the potential impacts on areas like private equity and private credit.
Yeah, absolutely. There are a lot of moving parts right now. And, it's a situation where there's not a ton of, backward-looking data that you can point to and make observations and decisions from. It's a new thing that the market's got to digest and figure out in real time. So this is clearly having a significant impact on markets. And, to set the stage for our conversation, we want to walk through, what the transmission mechanisms are by which tariffs could affect companies and markets in general.
Yeah, and I think it's always good in these types of situations when there's so much uncertainty and volatility to kind of start with first principles on this type of thing. So the way I kind of look at tariffs and their potential downstream impacts on companies and markets, you have your direct impacts, right? So you have tariffs are a tax on imports. So, any company that imports either finished goods like a retailer or intermediate goods like a manufacturer is going to likely see input costs go up and potential supply chain disruptions as well. So that's clearly a direct impact. And number two is the impact on retaliation, or from retaliation, I should say, on the revenue side. So companies who have significant overseas revenue bases, certainly we see that in the large cap market today. Companies with significant businesses in China are getting hit really significantly. So obviously there's a significant revenue impact as well to the extent that retaliatory tariffs are put on. And then you have your indirect impacts, right? So tariffs can serve to reduce the purchasing power of U.S. consumers. They can serve to make companies more cautious on hiring, things like that. That can slow down the economy overall and obviously impact a broader swath of industries. The second thing would be uncertainty, which I think is sort of the number one impact today. Clearly, you're seeing companies uncertain what the future is going to look like, challenges in terms of how do I plan for further capital expenditures, how do I plan for hiring, M&A. There's a challenge for investors looking to fund any of those activities right now. So I think, obviously today the tariffs went into place and you're going to start to see some of the direct impacts come to play. But right now, or for the past couple of weeks, it's really been that uncertainty channel that's been the key transmission mechanism. And then finally, it's financing conditions, right? Higher inflation from tariffs can lead to higher rates, can lead to wider credit spreads, and ultimately tighter financial conditions.
Yeah, absolutely. And when we're thinking through this, and this is probably more on the direct impact side, but something that goes beyond just the retaliation of foreign governments in terms of their tariff policy. We increasingly live in an interconnected world. It's a little bit more polarized. We're of the view that there's kind of a rise in populist nationalist sentiment around the world. And as a result, part of this too is consumers can walk down the street and choose with their wallets. And, when you have a significant number of multinational U.S. corporations whose forward growth plans and earnings outlook is dependent upon additional penetration overseas, but they sell a commoditized good that is easily replaceable by a national brand, that type of thing, poses a risk as well, where consumers abroad, simply see this, feel they're being unfairly treated by the United States, and absent government policy, just make decisions with their wallets.
Yeah, and that goes for services too. I think this is seen as obviously, primarily affecting companies that deal in the goods trade, but Google, Meta, these companies do massive businesses abroad. And you could see eventually some retaliation either from governments or from consumers abroad there as well.
Sure. So obviously we've seen the uncertainty aspect. We've walked through that a bit. Heightened economic concern. We see, banks all across the street increasing their recession forecasts for the year. How does this volatility in public markets translate into private markets?
Yeah, for me, I think there's kind of two things here. So number one, I want to first hit on the difference between public and private markets, right? So in public markets, as we sort of just started to hit on, it's full of companies that are heavily exposed to globalization and to goods trade. So there's a stat out there that roughly, the U.S. economy is only about 20%, goods. When we look at the sort of the composition between goods and services in the entire U.S. economy, in the S&P 500, about half of earnings come from companies that primarily deal in the goods trade. So public markets much more, exposed to that potential disruption from tariffs on trade, and also obviously more exposed to sort of that retrenching on globalization. Valuations are much more volatile in public markets. Obviously, they trade minute to minute. We did see a significant run-up in public valuations over time. I think maybe you've got a stat on this you want to share as well. But, we had this big run-up in public valuations that we didn't necessarily see in private valuations. So I think some, I guess you'd call it, thinning of that margin doesn't necessarily mean it'll flow directly through to private valuations as well.
Yeah, no, I think that's right. If you look at private markets kind of across holistically, and you look at the enterprise value to EBITDA multiples that we've had over the past couple of years, if you look back and you take out 2021, which I think everybody in the industry acknowledges was kind of frothy, there was a lot of money coming around, there's a lot of stimulus in the economy. If you take that out, market-wide, we've gotten back to valuation multiples that are pretty consistent to what you had pre-COVID. Now, within that, you do see segments of the economy that kept valuations slightly higher. So, in global kind of M&A, $5 billion or more, the largest deals that are getting done, you had the 20.5 times multiple in 2020 on all those large deals that got done at the tail end of that year. But then in the successive 3 years, you still had valuation multiples that would have been, absent 2020, sequential all-time highs in valuation for the largest deals. Now, some of that had come out over the past year, but when you turn and look downstream toward your more middle market, lower middle market companies, you had a little bit of an increase in valuation during 2021, but absent that, valuations really leveled off to where they were pre-COVID.
And Alan, I think that makes a great point in terms of, that top end of the private equity spectrum, right? You saw valuations drift up alongside public markets, right? And part of the reason is because that part of the private equity universe is, significantly exposed to public markets, right? On both sides. Number one, from an investment standpoint, half of deals done that are $5 billion enterprise value or over are take privates from previously public companies, right? And then on the exit side, a significant portion of the exit activity that goes on in these mega cap funds comes from the IPO market. So as a result, you do tend to see valuations at the top end of the private equity world have higher correlations to public equity valuations. And so I think one way that you will see, this public market volatility bleed into private markets is at the top end there from a valuation standpoint, and in terms of more challenging exit avenues and potentially a tougher time getting deals done on those take privates as well.
No, I think that's absolutely right. And you contrast that to the middle market. Over the past 3 years, 99% of exits from middle market private equity has been either to strategic acquirers or sponsor transactions to larger buyout funds, which has played an increasingly prominent role in providing liquidity to middle market private equity investors in recent years.
Yeah, and I think this only sort of exacerbates that trend.
I think that's right.
So Alan, the other part of this is obviously, we talked a little bit about the equity markets. There's obviously a sell-off going on in credit markets as well. Spreads have widened significantly in leveraged loans and high-yield bonds. We're not yet at sort of crisis levels there as we speak today, but sort of walk me through your views on how this repricing in public credit markets could impact private credit.
Post-tariff announcements, spreads have widened 112 basis points. In the syndicated loan market, that spread widening has been, 45 to 50 basis points. And these are off of levels that, had near all-time tights in the syndicated loan market. We're looking for, good examples, previously that kind of underscore the dynamic that's unfolding today. And, we saw, with the bank failures, the regional bank failures in 2023, a pretty significant and sharp spread widening event there, particularly in high yield, where spreads widened 130 basis points. That episode was fairly quickly resolved. I think given the uncertainty today, we can't necessarily chart that against that same period for, the reasons of just so many unknowns. But that market took 5 to 6 months to recover from that episode, before continuing its trend tighter. In private credit, one of the things that we've observed is that in periods of market stress, the syndicated loan market tends to be more volatile. There doesn't tend to be a lot of new issuance. Deals kind of get put on pause for a period of time as folks figure out where things are heading. And in those periods, private credit has consistently kind of increased its market share in terms of the activity that does get done. And typically, as the syndicated loan market kind of closes and becomes less of a competitor to the direct lending private credit market, spreads tend to widen a little bit in private credit, particularly in kind of lower middle market, non-sponsored deals. And so we have seen a bit of a spread widening in terms of that premium, between sponsored and non-sponsored, kind of upper middle market and lower middle market credit. So the opportunity set there is shifting in private credit. And, I think, one of the things that it should tell investors is, big news that's consequential. It's better to have that, as a known variable when you're writing new loans.
Yep.
And so, it's one of those situations, again, where we've talked before, vintage matters, especially when new information comes out that's so significant. And so I'd much rather be a lender today building a private credit portfolio and looking for opportunities today in a higher spread environment, where I've got the benefit of foresight.
Yeah, and I mean, clearly what we've seen in the past recent episodes, you mentioned SVB, is that, when the syndicated loan market sort of goes quiet because there's this sort of uncertainty in public markets, the private credit space has actually acted as sort of a counter-cyclical force in credit markets to keep capital flowing to these companies that need it, and that really offers an opportunity for private lenders to come in and do deals at attractive terms. And I do sort of, I want to quickly hit on the rates idea too, because we talked a little bit about spreads, but we're also seeing an increase in benchmark rates right now, right? So I'm not sure where we are exactly.
Yeah.
I think we're around 435 on the 10-year right now.
So the 10-year's gone from, 386 pre-tariff announcement to 437. That's a pretty significant and sharp move, and, really seeing a breakdown in stock bond correlation.
Yeah.
And, not as much downside protection there on long duration treasuries is what folks might have expected.
Yeah, and I think, what you really hope for in this type of environment is that economic uncertainty and potential, economic weakness is offset by, an ability to access cheaper financing, at least eventually. You're not seeing that right now. This is inherently a supply shock right now, not a demand shock. So what you're seeing is a Fed that, is going to be patient until they really see economic weakness before they start to cut, right? And I think the bond market is reflecting that. I think it's also reflecting, the fact that investors are hesitant on U.S. assets right now. You're seeing the dollar weaken a bit this morning as well. I think investors want to see some stability and some certainty in U.S. assets before they start, going in and buying treasuries again. So I think, as we think through what that means going forward, that's going to be a challenge for borrowers, right? I would not want to be a private equity borrower that's, over levered right now that needs to refinance into this market. Obviously, you've got higher benchmark rates and wider spreads. That's going to be a challenge. And
I think, one of the things that we focus on very heavily is what is the source of value creation, for different private equity segments. And, a good starting point is to have a reasonable valuation at entry, and a good ending point is to have good exit optionality at the close. But in the midterm, what is the source of your growth? Is it, organic growth? Is it inorganic growth? Is it growing margins, making the business more efficiently? Or is a significant part of the value creation, predicated on leverage? And what we've consistently seen is that larger private equity deals and LBOs have a higher degree of leverage. I was looking at some survey data coming into the year, but a significant number of the largest private credit lenders, which have raised 60% of private credit capital over the past 12 months, were reporting a willingness to increase gross leverage on deals over 7 times. So that means that for those LBOs on the private equity side, leverage is a significant force in terms of what the net return is. And large private equity deals are implicitly kind of long credit spreads and long rates, to where, if rates come down, credit spreads tighten. That's very accretive to their bottom line, given the propensity of leverage. But when you compare that to like a middle market, maybe it's 4 times levered instead of 7 times levered type deal, now the fundamentals of the business can play a more significant role. And so certainly there's certain businesses that will be impacted. We think the middle market's a little bit more insulated right now, given the revenue exposure being much lower to foreign companies and more domestic-oriented growth plans. But again, that leverage component reduces the diversification benefit of private equity when it's such a significant part of the return stream.
Don't start the week one step behind the markets. Listen to the Market Minute, a podcast by FS Investments. Essential analysis from the FS Investments research team, new every Monday morning. Get a full recap on the latest in equities, fixed income, commodities, and macroeconomics, all in less time than it takes to finish your coffee. Don't start the week unprepared. Search for Market Minute by FS Investments, and make sure to follow for a new episode every Monday morning.
So, we've got uncertainty, we've got rate volatility, we've got credit spread volatility, and potential impact, on earnings and cash flow in certain industries, that many people came into this year very bullish on, expectations for a surge in M&A activity. Yeah. And early in the first quarter, we did see some of that. But now that appears to be waning, amid that uncertainty, as folks start to think about how to plan out long-term capital investments. So, Andrew, how in your mind does this ultimately have a potential impact on deal flow?
Yeah, I think we came into this year and, post-election, I think I'm not sure, we've ever seen as much euphoria and hopes for animal spirits as we saw coming into this year. Clearly, that's probably, teaches us all to guard against complacency a little bit.
Certainly.
But look, I think right now we're in the eye of the storm, right? It's really challenging to say what the ultimate impact will be on M&A activity going forward. Clearly, companies, private equity firms have, put deals on pause for now and are kind of trying to just figure out what the impacts of tariffs are going to be on the businesses that they're looking at. I think it is important to remember why part of the reason that we came into the year so bullish on M&A, part of it was hopes for tax cuts and deregulation and strong growth and all that. But part of it was also, number one, a demand to put all of this dry powder into the ground, right? But number two, it was also, you've got all these companies that are sort of aging within these funds and need to be exited as well. So I think there was a demand for deal activity from sort of both sides of the private equity life cycle, if you will. That still exists, right? So maybe we're not going to get this massive upswing in M&A, but I think to the extent we do get some clarity going forward, there is still sort of this higher base level that I think we can reach, again, if we eventually get some policy clarity.
So there are other aspects of the private equity market that might play an increasing role in that.
Yeah, and I think, you look at the secondary market, right? It's played a massive role in terms of providing liquidity to LPs and to some extent to GPs over time, as it's been challenging to exit some of these investments. The secondary market's been a key sort of release valve for some of that liquidity, to the extent that the exit environment remains challenging for the coming months and quarters. You're going to see some significant opportunity in the secondary market continue there.
No, I think that's right.
And now I do want to bring in Dan Wilk, again, our head of private equity solutions, for some of his thoughts on what's going on in M&A right now.
So the risk-off stance investors have taken is abundantly clear. It's abundantly obvious. But yeah, it's had a huge impact on M&A markets, completely going against what a lot of the expectations going into the year were. Through the first quarter of 2025, I think it's all of the tariffs, geopolitical risk, potential macro concerns. But what tariffs really do is add complexity, uncertainty, and higher costs to the deal. It makes cross-border transactions much less appealing, and it causes companies to reconsider or just delay some of the strategic acquisitions they were looking to move forward with. The uncertainty around tariffs, though, now causes, disparities in valuation expectations between buyers and sellers. Investors today are definitely focusing more on domestic-focused businesses that are less reliant on international trade headlines. And I think that is compelling folks to take just a longer view for diligence cycles. I think the increased diligence and heightened scrutiny around cross-border supply chains, raw materials, components, and so forth will certainly cause folks to just delay the ultimate transactions. But deals are certainly still getting done. I mean, in private equity, exit activity has completely negated the IPO market, right? You've had the same amount of IPOs in the second half of 21 as you've had in 22, 23, and 24 combined. Where you're seeing actually businesses change hands is actually through sponsor-to-sponsor sales. Sponsor-to-sponsor transactions are up about 26% relative to their 5-year average. So it has been interesting in that, look, there's been a war chest of dry powder that's been raised in the large and mega cap space over the last few years. That gets pressure from LPs to put to work, and typically it gets put to work in high quality companies that are growing in enterprise value. I think you're seeing a real tale of two halves between large and mega cap global private equity firms and lower middle market firms that are more insulated from the macro. As a perfect anecdote, only 15% of private middle market companies derive their revenue from overseas. So by that metric, you're naturally going to be half as affected. And I would argue through strategic selectivity and diligence, you can blend that weighting even lower. But we're certainly seeing M&A activity grind to a halt. I think folks looking to digest current headlines is really all we can say going forward.
So, we've outlined reasons why there's a lot of uncertainty in private markets as well as public markets. But, I think there are some key things for investors to think about right now. Andrew, what stands out to you as something investors should be focused on currently?
Yeah, look, I'll say a couple of things. I think number one, this is clearly a really challenging time for a lot of people. There's tons of uncertainty out there. We don't know how all this is going to end, what the economic impacts are going to be. Mm-hmm. I do think it's important as an investor to maintain a balance of caution and opportunism, right? Two things can be true. Mm-hmm. This is going to be a potentially challenging period for a lot of investors. And what we should all be doing is looking at our portfolios and trying to understand where our exposures are. I think at the same time, these periods do tend to be really attractive vintages across asset classes, right? Where they're talking about private equity, where you can maybe get into some really attractive companies at good valuations, mm-hmm. whether we're talking about private credit, where you can put, money to work at wider spreads, lower leverage points, et cetera. So I think it's important to, while acknowledging the uncertainty and risks that are out there, mm-hmm. to really maintain a balance and look for ways that you can take advantage of these mm-hmm. types of environments, right?
Yeah, I think that's right. And in credit, I think new vintage is really the story here. We talked before, it's better to have, knowledge of the significant information, how that impacts things when you're doing your deals. Also a lot of investors access the private credit market through fund structures. And, right now is a point in time where if new deal flow is a meaningful portion of, that fund's allocation and, the ability to drive exposure into this market with new deal flow, that's a better position to be in than kind of a more legacy fund, that's got a lot of exposure that's built up over the past 2, 3, 4, 5 years, especially, going through kind of a tech bubble, mini bubble in 2021. We see in the data that a lot of those loans are the ones that are already having the most challenges in private credit. And so, with new deal flow for a larger kind of already scaled fund like that, not moving the needle as much, I'd much rather be in the position of new vintage.
Yeah, I think investors should be asking themselves before making allocations to, private assets, how much of that strategy's assets are going to be deployed over the next year versus, how much are you buying into an existing portfolio, and when was that existing portfolio originated, I think is a really important question.
No, that's absolutely right. So there are opportunities in this market. There's an old parable that in every crisis there is opportunity. I think that's certainly the case for investors today. Headlines have been challenging, but, looking beyond that, getting smart about the exposure that you own, there are things to do that are exciting and attractive today.
Yeah, thanks, Alan, and thanks, Dan, for taking time out of his incredibly busy day right now to provide his thoughts as well. Before we end, I also do want to mention a few research pieces we've put out recently. We wrote a couple notes on tariffs that I think are still relevant as we go through this period right now. We've also just released our Q2 U.S. economic outlook, which again, making base cases are incredibly challenging right now, but I think it's useful to try to put some parameters around potential impacts. And then finally, for a longer term view, we did put out a paper called U.S. Exceptionalism at a Crossroads about a month and a half ago. We also put out a podcast on that as well. I think some of those themes we're seeing come through in real time.
Absolutely.
We do provide, I think, a more long-term view on how these trends could ultimately impact the investing universe. So I think, still incredibly timely to think about that as well. So Alan, thanks for your time.
Great. Thanks, Andrew.
This episode was recorded at the FS Investments headquarters in Philadelphia's historic Navy Yard. It was produced by the investment research team, edited and engineered by Aaron Sherman. Video produced by Melissa Venditti. Copy provided by Harrison Beck. Special thanks to show coordinators Ellie Zhang and Laura Coleman. If you enjoyed this episode, be sure to like and subscribe wherever you get your podcasts. Thanks for listening.